presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact Market Wrap Weekly Update for March 30th, 2026. I'm filling in for your longtime host, Mo Ansari, today. He'll be back next week. My name is Javaid Ansari, Executive Vice President here at Compact Asset Management. Of course, if you'd like to get these updates in your inbox on a weekly basis, please do subscribe to the Compact Communications. You can just go to compact.com/insights, put in your email, and you'll be notified every Monday or Tuesday, whenever we put up the YouTube and podcast editions here on the weekly edition of Market Wrap, of the new notifications so you can stay up to speed. Our objective here with the market update is always to try to be a signal through the noise, to really interpret the markets so you can understand what exactly you need to be potentially doing with your portfolio and your money. If you're trying to manage your portfolio by the headlines, you can see they're changing rapidly every day. You need to really have a compass to hopefully guide you through. And so I appreciate you listening to this YouTube update and on the podcast. But if you'd like to subscribe, please go ahead and do so. And as always, you can email us directly at invest@compact.com or give us a call at 800-388-9700. Let's jump into the numbers for the week. As we saw, the S&P 500, difficult week, down 2% last week. Dow held up relatively well at 0.9. Russell held up well. It was actually up 0.5%. Growth stocks, we're kind of continuing to see that rotation. If you've been watching Market Wrap for the last couple of weeks, you know that Mo, a couple of weeks ago, talked about his dot plot getting triggered to the downside. And so we still continue to think, as long as we're in this downward correction, that NASDAQ will be growth and NASDAQ stocks will continue to lead to the downside. And that's exactly what we saw last week, with the NASDAQ down 3.22%. Emerging markets also down, so just basically an off week, but still, as much as I want, I'll show you the charts, but only down, S&P's down, about 7% for the year. So still within that kind of, I know we're in a correction territory from the all-time highs because we were up in January, but still holding up, I think, relatively well. And I'm going to talk a lot about my charts that I look at. We look at a variety of different charts here at U2 at the Compact Investment Committee. But I'll talk some about the relative strain charts and high yield charts and why they're still telling us that we should probably try to hang in there as much as possible. And I think what the market's trying to wait for is some sort of pivot in Iran. And we're really going to get that indication really from the oil market. But the bond market is really saying, hey, hang in there. We did get a little bit of negative signals last week, so things, as they remain elevated, are starting to cause some more stress on both the bond and the stock market, as we're seeing last week and hear that these numbers. But still, I just want to say, it's one of those times where I think you still have to remain calm. Hopefully you have the right allocation. If you were too much invested into equities and it's starting to hurt now that they're down 10% off the highs, now's not a good, you don't have to worry. Hopefully you've made money over the last couple of years. Don't potentially worry about maybe backing that down to an 80-20 or 60-40 portfolio if it's for your financial plan, if it makes sense. And so really that's where the planning comes in play, because it really tells you how much you can ultimately be adjusting your portfolio on an ongoing basis. Looking at the sectors last week, energy up again, up almost 6.2% last week. It's the big winner so far this week at 41%. I'll talk about oil prices. As long as energy prices are still going higher, we're still in a difficult situation. I think that just means oil prices are basically set to be where they're at or potentially higher going forward. And so then these energy companies are continuing to make money. The big loser for the week was communication services, really driven by Meta and Google to a certain degree. Google's been doing very well, so pulling back a little bit. But basically Meta had some rulings against them in terms of their addictiveness of their social media platform. And so that gave a lot of worries regarding that stock going forward. So he's got to be careful. I still look at, overall, look at the sectors that are leading so far this year: energy, utilities, materials, consumer staples. Very much a defensive type of orientation as the market tries to figure out exactly what is going to be the long-term implications for this Iranian war and the effect it's having on global commodity prices. Speaking of oil, you can see we're at $94 a barrel. I'm going to show you my chart on DBO. So this is actually an ETF that tracks the oil futures. If you look at the oil futures, this is the spot price for WT crude. This is basically the crude oil that is in the United States of America. You also have different oil prices from Bahrain and Oman and Kuwait. Those prices have gone up much more, but this is the main price that matters for us here because this affects gasoline and everything else. And so clearly at $94 a barrel, we're starting to see it at the pump. I was driving by here in California. It's up to almost $7 here in Southern California in terms of a gas per gallon. Natural gas prices actually are down for the year, but that's looking at natural gas here in the United States. So once again, natural gas, a little bit different than oil. So if you look at the Strait of Hormuz, about 20% of global oil goes through that strait. So that's why you're seeing a much bigger effect on the oil markets than you are seeing on the national gas market. LNG and all of those, actually the Middle Eastern states, they only export around 3% of the global consumption. Natural gas is is very hard to transport. So traditionally what you see is natural gas being consumed locally. So we make gas here in the United States, we consume it here in the United States. We make gas in Europe, then you consume it in Europe. So it doesn't go in these big oil tankers and transfer around the world. Now we have seen definitely bigger increases in natural gas prices both in Europe and Asia, but particularly here in the US because we're a huge producer of natural gas and oil, we can consume it ourselves. So we're somewhat insulated. I know we're seeing it at the pump, we're seeing slightly higher inflation, but it's nothing that a lot of these Asian countries are seeing where they could potentially in the next couple of months see some sort of rationing and need to really curtail their demand just because they're not going to be having access to the imports of some of this gas and oil going forward. And that's why you've seen a big pullback in overall Asian emerging markets and international stocks so far this year. And then finally, the bond market. So I think the bond market is the key thing to really watch. What I don't like is we definitely did see a little bit of some recessionary fear starting to peek back into the market. You remember last week, President Trump said that we're negotiating with Iran, and then it kind of came out. Iran said, we're not really negotiating at this stage. And then throughout the rest of the week, we sold off. And you can see high yield down almost 0.5% relative to AGG for the week. So this is the first week where I've actually seen high yield down and down more. Once again, this is also due to interest rates going higher. So I'll show you these charts on here if you're watching on YouTube. I'm still feeling that I'm not quite getting the full-throated recessionary signals yet. When we do get that signal, what you will see is actually these bonds will go up and then high yield will be going down. And so that's when you're seeing interest rates actually go down and then the junkier bonds are losing money as well. That is your signal for a recession. We haven't quite got that yet. And I'll show you some relative strength charts in the technical analysis section of the market wrap update this week. But last week, definitely not moving in the right direction. But still, I think it's still telling us to try to hang in there as much as possible. So we got to continue to watch that very closely. One of the charts of the week that I saw from Goldman Sachs talks about that while we might be seeing, total return down 3%, and then including last week, this was a couple days before the close last week, while the drawdowns in the market have been somewhat muted, if you look at the overall dispersion of stocks that are down more than 10% this year, it's almost 40% of S&P stocks. You look at 2025, 72% of S&P stocks were actually down 10% during the year. And then particularly, which I do think we're in a similar market to 2022, the market was ultimately down 18%. I think we can go down anywhere between 10 and 15% this year, but hopefully we do bounce back with some sort of pivot in the Middle East. But during that year, 85% of stocks were down more than 10%. And the reason I bring this up is because if you just are investing in ETFs, yes, you're getting these returns, which have been great, but what you're not taking advantage of, particularly in your non-retirement accounts, so these are accounts that are trust accounts, joint accounts, et cetera, is this dispersion. And basically, if we're still trying to target the S&P 500, but we're doing it by investing in the individual stocks themselves, what you can do throughout the year is you can sell those stocks at a loss, potentially tax loss harvest that loss, and then offset that against any sort of future gains that you might have that year, or you can carry forward that loss into future years. So with a direct indexing approach, it takes a little bit more work. Of course, you're investing in individual stocks versus ETFs. You can potentially create some tax alpha in your non-retirement accounts. And that adds up over time because if you're able to, a lot of hopefully your Market Wrap listeners have nice large unrealized gains in their portfolio. If you're able to generate some of these losses due to the intra-year volatility, you can then offset those capital gains with some losses. You can rebalance your portfolio, maybe take advantage of getting a little bit more into bonds without taking that huge tax hit of the capital gains. So this is kind of gold standard portfolio management when it comes to managing your assets. So something to really think about, particularly as I do expect us to see continued volatility as we've seen now. Really, the last year we didn't see a lot of volatility, it was 2021, but over the last 4 or 5 years, we continue to see a lot of intra stock market or ETF volatility that you can use to your advantage if your portfolio is structured correctly. Finally, just talking about the asset classes for the year. We'll be coming up on the end of the quarter. All of Compact's clients will be getting our quarterly update YouTube that Mo presents, where we get into a lot of in-depth on the current market themes, show you a lot of our charts that you don't see here in the Market Wrap update that's only for our clients. We'll be doing that update at the next week, so stay tuned for that. As far as the commodity commotion, clearly commodities have been the breakaway this year. I don't know if people had that on their bingo card, being up 23% for the year. EM is still doing very well, still up 2.7%. Once again, I think AI is going to have a huge benefit for emerging markets over the period of time, really allowing them to kind of jump into the knowledge-based economy going forward. So emerging markets are doing very well. And then the large cap, US large cap down the most so far this year. So a little bit of a reversal. Clearly the things that have been doing really well, like US large cap taking a little bit of a breather. But I think diversification, as we've talked about, not only in your asset allocation, in terms of stocks versus bonds, but also when you're looking at your stocks, I think you do want to be looking at things like not maybe US small cap public equities, but maybe private equity, starting to look at developed markets, emerging markets. These are different things that you should begin to kind of start sprinkling into your portfolio. Just looking at the economic news last week, we had the PMI, both manufacturing and services, still coming in really good. Anything above 50 is positive. Manufacturing coming in at 52.4. Services coming in at 51.1. So economy is still looking very good. I think we're still going to see some, inflation pressure, and so some more interest rate sensitive sectors like housing, particularly, maybe even consumer spending for lower end consumers going to come down a little bit as we're seeing higher oil prices and inflation. But still, the economy is growing at a pretty okay clip. I would say not too hot, not too cold, right around 2% when we're looking at the Atlanta Fed GDP now number. Import prices have gone up, and then we will get jobless claims. We'll get the jobs number here on Friday. So the number is expected to be around 60,000. Once again, last year we were last month we were down negative 92,000. So we do want to see a little bit of bounce back, hopefully in the employment number, because we just don't want to see that going down too rapidly. We'll get some retail sales this week, but not a lot of economic news this week. We'll transition into the end of the quarter. And then really, I think the next big thing to really watch as far as economic news for the market is going to be earnings. As we really get into Q1 earnings for all the companies here in the middle of April, I think that could be a little bit of a solve for the market. I think it can really kind of, just kind of help the market refocus on, hopefully, what has been still a great earnings environment. We haven't really seen anything change in terms of the earning estimates, even though we're now seeing the commodity pressure. So if that kind of comes into fruition, that might be a time when we could see a little bit more stability within the market here versus it all just being really reactive to the overall oil headlines at the moment. So jumping right into the technical analysis, a little bit different style charts this week. These are some of my charts that I share with clients here on a daily basis during my reviews here Compact Asset Management. But one of the things I want to focus on looking at the S&P daily chart is some of these red lines. So these red lines, I talk about them in the past. So we have seen some going all the way from 6,300 down to 6,000. So these lines actually correlate with gaps that we saw back in June, some of the gaps we saw back in July when the market was really kind of taking off, and we can see some gaps back here. The reason I mark these on my charts is because the market tends to want to go back and fill these gaps. We had a lot of gaps going back here in April and November of last year, and we so far have filled that one. We filled another one at 63.40 today. I think, when it's all said and done, we're probably looking at this 6,000 number on the S&P. And what I drew here was, what is the drawdown? We see the ultimate high was sometime late January to the low at 6,000. That's going to be a 14% correction in the S&P 500 if we ultimately get down there at 6,000. I really, to be expected. I think if that's the extent of the drawdown that we see this year, given the situation in Iran, given we had elevated equity markets, that's actually, and we don't get those recessionary signals from the bond market as we continue to go lower, then that's your buying opportunity to potentially look to add a little bit of new money into the market if you still have the ability and it's right within your financial plan to do so. So we'll be watching that really closely. I think the key thing to really understand is that we're going to be seeing anywhere between 15 to 20% corrections annually in the stock market going forward until we get that big reset. Now, we don't want that reset. That's a recession. That's prices going down 30, 40%. I don't think we're seeing that right now because I'm not seeing that from the bond market. But I think it's really important to understand that if you are going to be an equity investor, you have to be willing to tolerate 15 to 20% declines. So we're talking, you have $1 million portfolio, that's going to fluctuate $150,000 to $200,000. If you're not comfortable with that fluctuation, maybe where you're at in your investing timeline, and now is potentially a good time when you start to see interest rates where they are today to start to rebalance so you're in a good position going forward for whatever might come. Hopefully we get that rebound. Yes, you're not going to participate in that full 100% of the rebound because you maybe rebalanced a little bit, but hopefully you've accumulated a lot of gains and you're able to basically make that change and protect yourself going forward. Looking at the weekly charts, you can see that the red lines just explode. This goes back to 2023 and 2022. I still kind of look at this 100-week moving average. It's also right around that 6,000 number. So I think all of that's in play. I don't know if we get much below that. I don't want to see us kind of getting back down to anywhere in the below 6,000. For the tariff tantrum back in April, we were down almost at 5,000. I don't think we're quite going back down to those levels. I think we only get back down to those levels if we're in a recession and we start to see earnings estimates getting drawn down. But right now, I think 6,000 is somewhat in play on the S&P 500, potentially being led by the NASDAQ composite. You can see here, NASDAQ broke down below the 200-day moving average about 2 weeks ago and is then accelerating to the downside. So I think the NASDAQ is going to continue to potentially lead the S&P lower. And then particularly you look here, one of the things I also look at on particularly my weekly charts is a thing called Bollinger Bands. And I like to look at Bollinger Bands because this is a 2 standard deviation Bollinger Band. And when I look at weekly charts, this tends to tell you when markets are getting basically oversold when you hit the Bollinger Band on the lower end, or when they potentially are getting overbought when you're hitting the Bollinger Band on the upper end. So you can see here back on the NASDAQ, we hit the upper end of the Bollinger Band back in October. That was basically when we've seen now the rotation out of technology stocks into all the other stocks happened in October of last year. And now we're kind of on the flip side. Now we're kind of extremely oversold if you're looking at the stochastics. And so I think we're getting closer to a bottom as we're starting to hit these levels. Now it all depends a lot. You can see here we hit the band back in April. That was a great time to buy. So I always like to look at from a weekly charts to look at these Bollinger Bands because it kind of takes out all of those daily fluctuations. It kind of looks things in a much longer term horizon. And I think we're kind of in the final, hopefully, throes of working through the NASDAQ correction here. And like I said, if we get those earnings coming out in the next couple of weeks, I think that could be the thing that could cause the market from going lower. IJR, so we're looking at small cap stocks here. I went back to a weekly chart because I want to go a little bit further back. You can see this chart goes back all the way to 2023. We made a high right here on IJR around 128. This is back in October of 2024. We had the big drop going back to the tariff tantrum, came back here. And then we finally broke out for just a couple of weeks here in 2026, but since then we've come back down. I'm still kind of, if you now look at small cap, it's gone basically nowhere for now going back to June of 2024. You compare that to the S&P and tech companies, they're up almost 12, 15, 16% annualized. I still feel like small cap, probably not the best place to diversify into. If you want to get access to some of the best small and mid cap companies, you have to do it through some of the private equity interval funds. And while I'm talking about private assets, another chart, I don't have it in this weekly edition, is looking at private credit. Private credit really has kind of found a little bit of support. It was actually up nicely today. I look at an ETF called BIZD to really track private credit going forward. It really kind of bottomed out at the beginning of March, right when the the attacks on Iran started. And so that's a pretty positive sign in my opinion. If we can kind of hold here, particularly seeing the huge rise in interest rates that we've seen, and that gets into some of our next charts here, on interest rates, interest rates have gone up a lot over the course of through May. In fact, they've gone from almost 4% to 4.4. Nice big down day today. And so I think given the fact that we've seen these interest rates spike a lot, and yet private credit has held up pretty well, it went down in anticipation potentially of that. I think that's a sign that maybe we're getting kind of through some of this gyrations on private credit. I don't think it is systematic. If you put your money in private credit, you're probably not getting it out of private credit anytime soon. So you're just going to have to kind of weather the volatility and flows associated with that. But when I really look at this 10-year chart, you can really see I'm drawing a triangle pattern here from the highs that we saw back in October of 23, and then also the lows we saw back in October, basically March of 23. And you can see this is like a converging triangle. And as this kind of gets tighter and tighter, eventually it's going to break to the upside or to the downside. Ideally, we want to stay in this range as much as possible. But I'm okay with interest rates going to the upside. I don't think we have a lot of long-term inflationary pressure. I look at the break-even rates. They haven't really gone up a lot in terms of the market expecting future inflation to go up. I think if interest rates do go higher a little bit, like they were just last Friday, that's a great time to buy some bonds. I think insulate your portfolio for whatever recessionary environment potentially might be coming later on down the road. It's really interest rates going below, right here around, I would say 4%, that would start to get me very concerned that there is a flight to safety, and we have to particularly see what high yield bonds are doing at that particular time. But I think the fact that, once again, interest rates have gone up in March and private credit's holding up relatively well is a sign that potentially it's not that systematic. IXUS, I'm just looking at a daily chart, just wanted to highlight, seemed to hold, this is looking at international stocks, the 200-day moving average really well. We broke below it during the day today, but rallied back, closed above it. So I think that's also a very positive sign that the market is telling us that potentially we're getting closer to a little bit of a bottom here. I want to, as we talked about last week, dive a little bit deeper into DBO. So the DBO, once again, is tracking the Western prices for oil, which I find particularly important for our economy, right, versus other prices around. This is a daily chart. You can see I drew a line. We made a low earlier this year in early January, and since that low, we've gone up here all the way up from basically $12 on DBO up to $21. That represents a 74% increase. Looking back at oil shocks that we've had in the past, there's usually a correlation between around 100% increase in oil prices and a bigger correction in the stock market. So we're well on our way. One thing I do like about this chart, it hasn't necessarily broken out to new highs. You can see it dropped on the news that Trump might be negotiating with the Iranians, but then it rallied back as we kind of found out that that's not necessarily happening to that extent. But I still feel as long as we're not making new highs, as long as we're not getting above 2150, the market is kind of taking everything, we're in a holding pattern, and hopefully things do break down eventually. Looking at a weekly chart, so I want to go further back, this is kind of how I look at oil as a commodity and investment over a period of time. You can see here, this chart goes back all the way to 2015, 2016. And you can see we had a huge drop in oil prices back in 2015 and 16. And that was directly correlated with fracking. As fracking in the United States became, as we realized this was going to be a huge net exporter of energy over time, it put oil prices in this new range here going forward from 2015. So you can see I have these blue lines that really outline the range that oil has been in. This is the lower end of the range. We went up, almost got back up to it. This is COVID back in 20, so the only time we actually got below the range was in COVID. I think you can ignore that. And then you can see these times when we've gotten back above the range. So this was 2022. This was the Russian-Ukrainian crisis, war, which is still going on, but clearly was unexpected, had huge impacts on oil and particularly natural gas prices all around Europe, particularly because a lot of that Russian oil was no longer available. And we've been basically trending along the upper end of this range for quite some time, but have been mostly trending down until just recently in March we've spiked back up. And you can see here we're at basically very similar levels that we were back during the original Ukrainian invasion. And so I think this is clearly there's a lot of other stuff going on too in 22 with the response to COVID and all the government spending and everything else that was happening that was creating all the inflation. I feel like if we can just hold here, and I don't know what we're going to do. No one knows what's going to happen. What's the policy going to be out of Washington? What's going to ultimately develop out of the Middle East? But I think if we can hold here and reverse lower on DBO here going forward, that's going to be a huge catalyst for the market to the upside. So time will tell. I think you need to have a little bit of a risk tolerance down at least a couple more percent to get through this one and just kind of basically position markets to be a little bit more cheaply priced relative to earnings, and then they can ultimately recover. Looking at gold, we made that high back here in late January. Seems like we're still in a corrective pattern, but also gold has found a little bit of some support here just over the last couple of days. I think it's a good time if you want to add a little bit of gold. You kind of felt like you missed out FOMO and the previous run up there in January. Now you can start to maybe dabble a little bit in gold. I think that diversification is your friend with all this volatility, so the more diversification you have, potentially better. And this is the final chart of the week. This is one of the key charts that I focus on almost daily here at the investment committee at Compaq. And this is high yield versus AGG relative strength chart. And what this is trying to show is basically what is the junkier part of the bond market, high yield bonds, telling us relative to more of the investment grade or treasury side of the market, which is AGG. And what we want to really kind of be wary of is periods where this yellow line, this is the relative strength line. So when this is going up, that means HYG is doing better than AGG. So that means it's kind of a risk-on environment, and people are willing to bid up the prices of high-yield bonds versus AGG bonds. You can see generally, this chart goes back to kind of middle of 24, we've been in a pretty kind of solid uptrend, right? We had one big dip here, and this was, once again, the April tariff tantrum. You can see here, high yield tanked in the early part of April, and AGG went up in the early part of April. So that's why you saw this big drop in the relative strength chart back then. So the market, when it basically got wind that the retaliatory tariffs were going to be as large as they were, basically said, if we continue down this road, we're headed towards a recession. And clearly there was a change in policy by the administration rather quickly as they saw these dynamics in the bond market change, and then things slowly but surely definitely recovered. You can see high yield doing very nicely coming out of that correction period. So then we fast forward to today. If we look at February and we go down, you can see high yield is going down, which isn't great, but so is AGG. So what that tells us is we've just really seen interest rates rise. And as interest rates rise, that's going to put pressure on AGG. It's also going to put pressure on the stock market. But we're not seeing that big spike lower in relative strength. In fact, today we saw some very positive relative strength in the market. So like I said, a little bit last week, getting me a little bit concerned, starting to see things go down, but nothing in the same realm that we saw back in April of 2025. So bond market's still kind of saying, let's take a wait and see approach. I think that's the prudent way of navigating this volatility as we kind of get through this. If you have too much risk in your portfolio, you're getting anxious about those 15% corrections when you do get some bounces, or even now's a good time to be maybe rebalancing that portfolio, because that is going to be the volatility in the stock market going forward. But we're going to continue to monitor this chart, and if this thing turns negative, well, that's really when you have to then kind of get some of your hedging strategies and a little bit more of your tactical management in place, because we could be heading for some bigger corrections, much more below 6,000 on the S&P. So that's it. Once again, please do subscribe to the YouTube channel. We appreciate all of your listenership here on the weekly edition of the Compact Market Wrap Update. You can email us anytime at invest@compact.com, that's COMPAK.com, or give us a call, 800-388-9700. I personally will be able to speak with you, talk to you about your portfolio, see how we can hopefully help you get in a good position to weather this volatility that we're seeing now, and unfortunately most likely you're going to continue to see going forward. Doesn't mean we can't make money. It just means that you're going to have to really earn it as we really kind of work through and head higher, hopefully, for here going forward. So let's run through the disclosures. But that's the end of the edition for this weekly edition of the Compact Market Wrap Update. I'll see you again next week with Mo. Until then, good trading.
This presentation contains the current views and opinions of Moeez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors, because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.